Hello traders, welcome back to my channel. It's good to see you again and it's good to be back again. Today I have this topic I want to discuss with you, and it's one of the chart pattern which most of us must have known about, and that's a double top. Double top is one of the chart pattern where I consider it as a chart reversal chart pattern. And the reason why I said it's a reversal chart pattern is simply because whenever you're trading any financial market, either cryptocurrency, stock, or forex trading, whenever you notice or you see a double top, mostly on the higher time frame, like the 4-hour time frame, the daily time frame, and the weekly time frame, it's mostly significant. And the reason why I said that is because when you see a double top in front of your screen on any financial market you're trading on, is a sign of weakness in buying momentum from buyers. This is trying to show you that there's weakness coming into the market where buyers are kind of losing, or whereas the trade or the currency pairs or the cryptocurrency or whichever one you're trading at that moment is currently losing buying momentum. So when you notice a double top in a financial market, all you have to do is to check and look at what is the next thing you need to do. So today I'm going to take you over to my screen, my chart, and show you one of these double top I'm looking at. And this double top it appears on the British pound and the USD, which is the British pound and the USD dollar. So like, for instance, now I'm going to use this higher time frame, which is the daily time frame. And I'll use this as an example. Now look at what actually happened here. Look to my left hand side here. Here we notice this first swing high, which is the first peak level, and price fall back to create a neck, a higher low. This was the previous swing high, and we have a swing low, which is higher low. Then the next level we'll be looking at for price to move above this first swing high. But what did price did? Price failed to break above this level here, and instead price produced a big thick bearish engulfing candle that's thicker than the previous candlesticks here. And you can see our price fell below the neckline. Now, according to the law of textbooks, textbook says the normal way to trade double top is when price breaks below this neckline. Now, price did actually broke this neckline and gave us this thick bearish candlestick. But look at what actually happened. Price failed to move lower compared to the size of the top. And textbook says, when you trade in double top, for you to get the target profit, you measure the neckline. You measure the top, which is the second peak of the double top, to the neckline. And that will be whatever you can get from here. The difference will be the take profit level. So now, if you look at the profit, if you look at the margin from the neckline to the top, it's more higher compared to when price broke this level and gave us this bearish candle, compared to the profit level, which is so little compared to the size where the top to the neckline. So what I decided to do is, anytime I see a double top like this, once I look at the higher time frame and I notice it appears on a daily resistance level, or it does appears on a weekly resistance level, what I will do is once I see a thick bearish engulfing candle for resistance like this one on the daily time frame or on the 4H time frame, once I see this and I know it's bigger and it engulfed the previous candlestick and is on the weekly or the daily resistance level, once I see this thick bearish candle, all I do is I wait for the close of this candlestick and I'll wait for the next candlestick to form. Then I'll sell from this level to somewhere below the neckline, just like, for instance, this level here. The reason why I say this is because once I say this, if let's say I'm supposed to lose, like let me say I'm supposed to place my trade on this, and I have this mind of losing $100 to make $300, which is 1 to 3, or lose $100 to make $200, regardless. Now, and I put my stop loss above this level. Let me say the swing high here. Now, I believe that in as much $100 is not that much, maybe just 1% or 2% of my trading account, I can still manage with that, even if the traders go above and break and continue uptrend. I'll take that as, okay, it's normal. You don't win the market every time. But once I know my trading strategy correspond with what I'm looking at on the higher time frame, due to the exhaustion of buying momentum from buyers, that made me to do that. So if I enter from here and I target from this level here, so that means I'm making 1 to 2. So that means I'm losing, I want to lose $100 to make $200, which is 1 to 2. It's better for me to do that than, like, for instance, let me say if price breaks below this level here, and we have this thick bearish candle here that failed to materialize the distance from this neckline to the top line. Now, as soon as we see this thick bearish candlestick, we'll be like, oh, okay, market is ready to go all the way down. But look at what market did. Let's assume I entered from here and I'm aiming the same length from this high to this neckline. Look at what price did. Price barely moved 1 to 1 before price shoot back up to this level. Price actually came back to the neckline, failed to produce a thick bearish engulfing candle or to produce a pin bar to signal price continuation to the downtrend. But look at, as soon as price came back here, it lobbied and stayed for a while, then shoot back up to the neckline to make triple top. So what I decided to do is, if I had wanted to trade it in the textbook way, I'd wait for this price to break below this neckline. I enter at the below of this closed thick bearish candlestick. Then I'll measure my profit from this level. I mean, from like the neckline to the top, that will be my profit from here to somewhere here. So I'll know I'm making 1 to 2 based on the size of the head to the neckline. But now let's assume I enter from here, which is this top here, the second top after the close of this bearish thick engulfing candles. I'll be making 1 to 2 already. Then for me to say, okay, I enter from here and I put my stop loss somewhere here and I entered here. And look at what happened. Price break back and went out the way up. So definitely I will be losing more money compared to, or me already being profit all the way from here to this level here. So what I'm trying to say in the sense is that I'm not disputing the textbook's method, because the textbook says always trade double top at the break of the neckline. Then you measure your profit from the neck, from the second touch to the neck, and that will be your profit level you'll be aiming for. But most of the time, price don't actually go down more, unlike the top from the profit level from the top to the neckline. It doesn't happen most of the time. So what I've decided to do is, whenever I'm placing this trade, I'll only put small loss, like maybe lose only 1% of my account. And if I see trade break below this neckline here, then I might decide to add more units or more unit to my trade already to see if it will continue downtrend for me to see profit. Because if I enter from this level, where am I going to put my profit? Where am I going to put my stop loss? I'll be putting my stop loss somewhere here, and which will be too large for me. You know what I'm saying? So this is what, after I've back tested it, And I've seen that majority of the time, price don't usually move below the neckline, like the price level from the top to the neckline. So that made me to decide anytime I want to trade double top, I see this kind of bearish engulfing candlestick or bearish pin bar, I'll just enter the trade, lose 1% of my account. And if it goes my way, it goes my way. And if it doesn't, then I know, okay, the trade setup is not nice, but I know I'm not losing too much. So instead of coming sometimes after this break of this bearish candlestick, that you decided to enter the trade and thinking you're going to be keeping going down. And look at what happened. Price break above and went back to create triple top, and the triple top before breaking below this previous swing low. So this is what I decided to share with you guys, that we say always all the time we have to follow the textbook. If yes, fine, but we still need to also backtest and see some other strategies that can make us more money in the trading than losing more money. So the textbooks is still nice. I'm just showing you another way of which I trade the double top. I still keep and I still respect the double top according to the textbooks. But if there's any way we can trade the market a way to suit ourselves and to suit our trading risks to reward, I think that would be another thing to do as well. So this is what I just want to share to you. Anytime I see the double top, most of the time I still wait for price to break below this level, give me a bearish candlestick for continuation, and I enter. But I'm just saying that sometimes I look at it, once I see this kind of bearish engulfing candlestick at the top, it says bearish reversal signal that shows me that buyers and sellers are now like taking over the market. But most of the time, according to the textbook, it's always good for price to break below the neckline, either pull back, give us a sell signal to continue to enter. But what about if it doesn't happen? What about if it does happen and price still shoot back up and take you out? But you know you're not losing too much from here. So this is what I want to discuss with you tonight. So if you find this as interesting, please give me a thumbs up, like my video, share my video, and just comment and subscribe. And thank you. And I believe you learned some more, one or two things. And you can as well backtest it and see and check if this does make sense to you. And if it does, give me a thumbs up, like my video, and share. I'll see you some other time. This is Mutu again, the Eagle Trader. Take care of yourself and have a good day. Bye.